Chasing Wisdom podcast.
Yeah. This is Chasing Wisdom. Real life, real money, real faith. I came up with a prayer and a plan. Kept my name on the line. This is Chasing Wisdom.
Real life,
Real money.
real faith.
I've been counting every step. Now I'm pressing through the noise. Hands up when the truth hit. I was built for this choice. This is Chasing Wisdom.
Real life,
Real money, real faith. Fade it out, then cut it clean. Chasing wisdom.
What up? My name is Ryan Lawson, and this is Chasing Wisdom podcast. How y'all doing today? This is the podcast for making money, fixing credit, talking Jesus Christ, and getting to the bag. So without further ado, we're gonna get into it. And today's topic is the hidden tax playoff. The write-offs most accounts never tell you about. So these accountants ain't telling you this game right here, but I'm gonna give you the wisdom and I'm gonna give you the knowledge. So why do most accountants leave money on the table? Most accountants operate in a reactive mode. They wait until tax season arrives, gather your documents, and file based only on what you hand them. This approach means they have zero visibility into decisions you made throughout the year that could have been structured for maximum deductions. Proactive tax planning means work with a strategy before transitions happen, not after. For example, deciding to purchase equipment before December 31st versus January 2nd can change your tax liability by thousands of dollars. The business owner who schedules quarterly tax strategy meetings will always outperform the one who shows up in April with a shoebox of receipts. So, tax savings are built throughout the year, not discovered during tax season. So, understand before tax season even come around, you want to be building your strategy. You know what I'm saying? You want to be implementing things. So we're going to get into how to read your own profit and loss statement for tax opportunities. Your profit and loss statement is one of the most powerful tax planning tools you own. The most business owners never look at it throughout a tax lens. Every line of item on your PL represents either a legitimate deduction already captured on your potential deduction or a potential deduction you may be missing. Start by reviewing your monthly P&L and flagging any business expenses categories that seem unusually low compared to your actual activity. This often reveals costs you paid personally but forgot to run through the business. For instance, if your a professional development line is zero, but you attend 2 industry conferences, you have uncaptured deductions running through your P&L at least quarterly and treat it like a tax opportunity audit, not just an accounting report. Your P&L is a tax opportunity map, a low category line, a question, not a good sign. So now we're gonna show you how to set up the system automatically to catch these deductions that you're missing. The most effective way to never miss a deduction is to build an automated system that captures expenses as they happen rather than trying to recall them months later. Start by dedicating a separate business checking account and a business credit card exclusively to business expenses. This single habit eliminates the need for manual sorting and dramatically reduces missed deductions at year end. A cloud-based bookkeeping software like QuickBooks weighs FreshBooks to categorize transactions weekly rather than monthly or annually. Connect your business accounts to your bookkeeping software via bank feed so every transaction is imported automatically. Finally, create a recurring 30-minute weekly calendar block called Receipt Review to catch any cash transactions, mileage logs, or miscellaneous expenses that need manual entry. So, separation creates clarity. One dedicated business account stops deductions from falling through the cracks. So, what you need to do is set up one business account and one business credit card for all your business transactions and your business related expenses so that you can catch these things that's slipping through the crack because you got it all coming in one. You can separate it. Now, the biggest 5 overlooked deductions by business owners is one, the home office deduction. You know what I'm saying? The home office deduction is one of the most misunderstood and underutilized write offs available to self employed individuals and business owners, largely because unfounded fear of audits. To qualify, you must use a specific area of your home regularly and exclusively for business. This does not require a separate room, but it does mean a defined space. The IRS offers two methods. The simplified method allows a flat $5 per square foot up to 300 square feet, while the regular method calculates actual expenses based on the percentage of your home used for business. The regular method almost always yields a larger deduction covering the proportionate share of rent or mortgage interest, utilities, homeowners insurance, and repairs. If your home office is 200 square feet and your home is 2,000 square feet, 10% of all qualifying home expenses become deductible business costs. So catch that game, y'all. So basically, depending on how much space you using for your dedicated space for your business, like how I got my podcast right here, I can deduct this on my taxes just by this amount of space. You know, the regular home office method almost always beats the simplified method. Do the math before you choose. So before you choose, figure out which one is gonna give you the most on the deductions. Now, the second one, vehicle expense, standard mileage versus actual cost method. So these are the two ways to get the vehicle expense deduction. If you use a vehicle for any business purpose, driving to a client meeting, job sites, run supplies, or conferences, you have a deductible expense that millions of self employed people consistently underreport. The IRS allows two methods: the standard mileage rate, which in recent years have been 65 to 70 cents per mile. 65 to 67 cents per mile, or the actual cost method, which tracks real costs like fuel, insurance, maintenance, registration, and depreciation. The standard mileage method is simpler but often leaves money on the table. If you drive a less fuel efficient vehicle with high maintenance costs. The actual cost method requires meticulous records but can yield significantly larger deductions, especially on your newer or more expensive vehicles using Section 179 or bonus depreciation, regardless of the method. If IRS requires a compartmentness mileage log, that record, the date, destination, and business purpose, and miles for every trip. An app like Mile IQ or Everence makes this nearly effortless. So no mileage logs mean no deduction. Start tracking every business drive today with a mileage app. So that right there is big key. You need to track the mileage that you're doing. For example, if you doing Uber, DoorDash, Curry, or any kind of delivery service, download the mileage tracking app so that you can get your deductions at the end of the year, because you want to go with the method that you get by the mileage. You don't want to go with the standard 67 and this, you know what I'm saying, percentage. You want to actually track this and get the maximum deduction. Yeah, you want to get that. Nah, the third way is health insurance premiums. Self employed individuals can deduct 100% of health insurance premiums paid for themselves, their spouse, and dependents as an above the line deduction on a Form 1040, meaning it reduces your adjusted gross income even if you don't itemize. This deduction applies to medical, dental, and vision insurance, and it is one of the most impactful write-offs available to business owners because it directly lowers your taxable income before calculating self-employment tax. The key eligibility requirement is that you cannot have been eligible for an employer-sponsored health plan through either your own employer or your spouse's employer at any time during the year. S corporation owners must have the business pay the premium directly or reimburse them and include the premium amount in W-2 wages to properly claim the deduction. Many self-employed individuals pay these premiums personally and simply forget to report them because no 1099 or form is generated. It falls entirely on you to track the report and report it. Self-employed health insurance premiums are 100% deductible above the line. Track every premium you pay and report it. Track and report. Track and report the premiums. You paying it. Track and report it, you know what I'm saying? Nah, this is the advanced write-offs that change the tax game, baby. These events, you know what I'm saying? Retirement accounts as tax weapons. So SEP IRAs, solo 401k, and simple IRA. Contributing to a retirement account as a self-employed person is one of the most powerful tax reduction strategies available because every dollar contributed reduces taxable income dollar for dollar with zero spending required. You simply move money from one pocket to another while eliminating tax on it. As SEP IRA allows contributions of up to 25% of net self-employment income with a maximum of $66,000. In 2023, the contributions can be made as late as the tax filing deadline, including extensions. A solo 401k is even more powerful for higher earners because it allows both an employee contribution of up to $22,500 plus a profit sharing contribution of up to 25% of compensation for potential combined maximum of $66,000 or $73,500 if you are over 50 years old. A business owner earning $150,000 in net profit who maxes out a solo 401k could reduce their taxable income to under 90,000, a potentially massive change in tax bracket exposure. The best strategy is to calculate your maximum allowable contribution in Q3 so you can either plan cash flow accordingly rather than scrambling at the end of the year. So retirement accounts are tax weapons. Maxing them out is one of the fastest legal ways to reduce your taxable income. And you got up to the tax deadline. So, you know what I'm saying? You got to move that money real fast and reduce your taxable income. Do what you got to do. It's basically what that part is. That's advanced right there. They ain't going to tell you that. All right, section 179 in bonus depreciation. Writing off equipment immediately. This game, y'all. So understand when you catching this podcast, make sure you locking in and catching game. Cause I'm gonna show you how to make money, save money, flip money, get money. You know what I'm saying? I'm gonna teach you about credit, how to repair it, how to grow it. You know what I'm saying? How to utilize it. You know what I'm saying? Tips and tricks. I even got tricks on how to get the loans and flip loans, all type. I got the game. I got the wisdom. If you lock in with me, you subscribe, you follow, you like, you share, get on all the damn socials, whatever. You follow me. You know what I'm saying? You follow me, you lock in with me, you gonna grow, you gonna learn, and you gonna get to that bag. You know what I'm saying? So without further ado, we're gonna get back into it. Writing off equipment immediately. Normally, when a business purchases equipment, vehicles, or property, the cost is spread out over several years through depreciation. But Section 179 in bonus depreciation allows business owners to deduct the full cost of qualifying purchases in the year they're placed in service. Section 179 allows deductions of up to $1,100,060. In 2023, for qualifying businesses, property including computers, office furniture, machinery, and certain vehicles over 6,000 pounds gross vehicle weight, bonus depreciation, which has been phased down from 100% in 2022 to 80% in 2023 and beyond, allows an additional first year deduction on new and used qualifying property not fully covered by Section 179. A business owner purchasing a $75,000 SUV with a GVWR over 6,000 pounds could potentially write off the entire vehicle in the first year rather than spreading it over 5 years. Strategic timing of equipment purchases near year end combined with Section 179 elections can turn a profitable year into a dramatically lower tax year without any negative cash flow impact. So check it out. Section 179 turns major equipment purchase into same year tax deductions. Time your purchases before December 31st. Gang. You know what I'm saying? Get the wisdom, baby. Get the wisdom. Because it's here. I'm giving it to you for free. Just lock in with me. Like, share, subscribe. You know what I'm saying? So I keep spreading this and getting this to the gang. You know what I'm saying? Getting this to the people, the masses, the game, the juice, the sauce, whatever you want to call it. I'm giving it. I'm spreading it. I'm sharing it. You need it. I got it. Come get it. Now, the Augusta rule. Legally rent your home to your business. Y'all ready for this? This deduction. IRC Section 280 AG, commonly known as the Augusta Rule, allows a homeowner to rent their personal residence to their business for up to 14 days per year without reporting the rental income on their personal tax return, making it completely tax-free rental income. Simultaneously, the business deducts the rental expense, creating a legitimate transfer of money from your business to yourself that is deductible to the business and tax-free to you personally. To use this strategy legally, you must charge a fair market rental rate. Document this by getting quotes from comparable events, venues in your area for meetings, strategy sessions, board meetings, or company retreats. The meeting or event must be legitimate business purpose with documented agendas, attendee lists, and business outcomes. A business owner who rents their home to their company at $1,500 per day for 12 meeting days can shift $18,000 from the business to themselves tax free while the business deducts the full amount. This strategy works best for S corporations and C corporation owners. So that's another game. Big tax deduction, the Augusta rule. The Augusta rule lets you legally move money from your business to yourself tax free and document everything meticulously. You know what I'm saying? So basically, have home meetings, document them, have your company members over. You can do this for 14 days throughout the year. And you can deduct the fair market value of your rent off your business tax by renting your property to your business just by having meetings or whatever you want to do, just as long as the agenda is business related to your business and documented well, you can deduct this off your business tax. Major sauce. And you ain't gotta lose no money doing it. You ain't gotta move no money to do it. All you gotta do is hold the event at your place. That's game. And you can deduct up to 14 days per year. That's game. That's thousands of dollars you can literally write off on your business and save. Now, just think of all these ways I just gave you in these deductions. You can majorly and dramatically reduce your business tax liability. We're going to keep going though, y'all. Now, the deductions hidden in plain sight. These are the ones in plain sight. And people overlooking them. They not even thinking about them. You know what I'm saying? This is Chasing Wisdom Podcast. Make sure you locking in, baby. Education and professional development, deducting your growth. Business related education expenses are fully deductible when they maintain or improve skills required in your current business, trade, or profession. This includes online courses, books, industry publications, coaching programs, certifications, seminars, and workshops. The critical distinction the IRS makes is that the education must be related to your current work, not education qualifying you for a new career. A marketing consultant can deduct an advanced copywriting course, but not a nursing degree. This deduction is frequently missed because business owners pay for courses and books from personal accounts or simply forget to categorize them as business expenses. When filing a committed business, excuse me, y'all. When filing, a committed business owner who invests $5,000 annually in a course, masterminds books, and professional coaching has a fully deductible expense, and many successful entrepreneurs invest far more. Always pay for professional development from your business account and maintain a file with receipts and a brief note on how each item directly relates to your business. So every dollar you spend improving your business skills is a tax deductible expense. Pay from your business account and keep receipts so that you can deduct this at the end of the year. So all these courses you getting from the gurus, all these books you reading and getting to improve your skills for your business. And it's the era that we got a lot of that going on. People getting these books and paying these courses, trying to get better at their craft. This is the tax deductible expense, and most people are sleeping on it because they paying out their personal account. But if you pay this out your business account, then you can deduct this at the end of the year. Now, another one, meals and entertainment. Now, this is what survived the Tax Cuts and Job Acts. The Tax Cuts and Job Act of 2027 eliminated 50% deduction for most entertainment expenses, but business meals remain partially deductible when properly documented, making it critical to understand exactly what qualifies and what doesn't. Meals are 50% deductible when the primary purpose is business. The taxpayer or the employee is present and the expense is not lavish or extravagant. This includes meals with clients, prospects, and business partners or team members where business is discussed. A 100% deduction is allowed for meals provided to employees on the business premises for the employer's convenience, and for and for meals at the company-wide events like holiday parties or team celebrations. The IRS requires documentation of who attended, the business purpose, and the amount. A simple note on the back of a receipt or a digital log satisfies this requirement. Meals purchased alone while traveling for business are 50% deductible. Restaurant meals ordered during client calls or strategy sessions also qualify when properly recorded. So understand, business meals are 50% deductible. Document who you met, why, and how much you spent every single time so you can deduct it. Nah, here goes some more game, more wisdom. Hire your children and spouse. Family employment tax strategy. Yeah. Employing your minor children in your business is one of the most powerful and completely legal income shifting strategies in the tax code. Wages paid to your children are deductible business expenses for you and taxed at your child's much lower tax rate, often zero. Children under 18 employed in a sole proprietorship or a spousal partnership are exempt from FICA taxes, Social Security, and Medicare, amplifying the tax benefit significantly. For 2023, a child can earn up to $13,850 without owing any federal income tax due to the standard deduction, meaning you can shift nearly $14,000 from your higher tax bracket to your child tax free. Understand that? The work must be legitimate, age appropriate, and paid at a fair market rate for the actual task performed. Suitable jobs include social media management, filing, cleaning the office, photography for the business, or data entry. Document everything, create a formal job description, keep time records, and pay via direct deposit or check rather than cash to establish a verifiable paper trail. So, employing your children in your business shifts income into a lower tax bracket legally. Document all the work throughout and pay fair market wages. So go ahead and hire your kids to do the little stuff you don't want to do. Clean the office, manage the social media, which they might be way better at. And photography and data entry, the light work. And go ahead and ship that $13,000 because that's what they can get up to tax free on their end. And that's going to give you a tax deduction on the business end. So, you'll flip the money. That's another deduction. I'm giving y'all gems. I'm giving y'all these tax deductions that you can actually put into your business. You probably can get down to 0% if you implement everything correctly. So if you're soaking in this game and you really paying attention to what I'm telling you, you understand I'm dropping the game. I'm dropping gems on you. I'm giving you what you need to make money. and grow your business and beat the tax end. So if you listening and you locking in, make sure you liking, sharing, and subscribing to Chasing Wisdom Podcast, and you spread the word and let these people know where the gain coming from. Nah, quarterly tax reviews, the meeting that pays for itself. The single most high ROI habit a business owner can develop is a structured quarterly tax review, ideally conducted with a CPA or a tax strategist rather than just a bookkeeper. During each quarterly review, you should analyze your year to date income and expenses, estimate your current tax liability, identify any planning opportunities specific to the next quarter, and make strategic decisions about purchases, contributions, and income timing before they happen. This meeting typically takes 60 to 90 minutes and should cover projected annual profit, retirement contribution optimization, potential equipment purchases under Section 179, and any planned travel or education expenses and payroll decisions for family members. Business owners who conduct quarterly reviews consistently report finding thousands of dollars of tax savings that would have been missed under an annual filing approach. Come to each meeting with an updated P&L in your mileage log, a list of any major planned purchases, and questions about any new income sources or business structure changes you're considering. All right. So it's 4 90-minute quarterly reviews with a tax strategist can save more money than any single deduction you'll ever find. You know what I'm saying? So take these deductions I gave y'all and take them to that meeting, these quarterly meetings, and make sure you figuring that out, working that out together. Now, choose the right business entity structure to minimize taxes. Your business entity structure is one of the most consequential tax decisions you'll make. Yet many business owners default to sole proprietor and stay there indefinitely, often overpaying self-employment tax for years as a result. Self-employment tax currently 15.3% on the first $160,200 of net earning in 2023. It's one of the largest tax burdens for the self-employed, and electing S corporation status can legally reduce this burden once your net profit consistently exceeds 60,000 to 80,000. As a S corporation, you pay yourself a reasonable salary subject to payroll taxes and take additional profits as distributions, which are not subject to self-employment tax. A business owner can earn $150,000 in net profit operating as a sole proprietor, pays self-employment tax on the entire amount, while the same owner structure as an S corp paying a $70,000 salary saves roughly $12,000 to $14,000 annually in SE tax alone, self-employment. The S corp structure comes with administrative costs, including payroll processing and more complex bookkeeping, so the break-even analysis is essential before making the switch. So your business structure is a tax decision. Revisit every time your income level changes significantly. So this is something you really want to pay attention to and think about, because depending on how much money you're making, you can save on self-employment tax. Like right now, I'm probably gonna be paying a lot in tax. I made a ton of it. I thank the Lord Jesus Christ for the blessing though. But I made a ton of money self-employed, and I know I'm not looking forward to tax season. You know what I'm saying? Sadly. But it's all a blessing. It's all a lesson, We got to go through this and learn the steps to save this money the next time. All right, your 12-month tax action plan, from reactive to strategic. Transforming your tax situation from reactive to strategic requires a documented, time block annual plan that turns one time tactics into permanent habits. In January, review your last year's tax return with a focus on missed deductions and update your chart of accounts in your bookkeeping software to capture new expenses categories. By March, ensure your mileage logs are current. Review your business entity structure with your CPA and confirm retirement account contributions are on track. In June and September, conduct quarterly tax reviews with updated P&L statements, estimated tax projections, and list a major planned Q3 and Q4 purchases. By October, calculate the maximum allowable retirement contributions. Complete any planned equipment purchases to capture Section 179 in the current tax year and implement the Augusta rule if able in December. Make final charitable contributions if deductible. Conduct a year-to-end bonus review for employees and confirm all business expenses been properly categorized before closing the books. This system, when followed consistently, compounds over years. Business owners who operate strategically for 5 years can save multiples of what they saved in 1 year. Strategic tax planning is calculated habit. Schedule your tax actions month by month and execute them like clockwork every year. So those are the tax deductions, y'all. I just gave y'all a dang mouthful. I ain't gonna lie. I just gave y'all so many gems just now as a business owner and self-employment operator, whatever you want to call it. I just gave y'all so much gain to save on taxes at the end of the year and probably get you down to break even or zero on the tax payment side. You know what I'm saying? So if you take these gems and you lock in and you put all this stuff in your business, I'm pretty sure you're gonna be a happy camper. This is Chasing Wisdom Podcast. Make sure y'all locking in. Make sure y'all following. Make sure y'all subscribing. And make sure y'all coming back every video. I am Rodney Lawson, and this is Chasing Wisdom Podcast. I'm going to see y'all next time.
Yeah. This is Chasing Wisdom. Real life, real money, real faith. I came up with a prayer and a plan. Kept my name on the line. This is Chasing Wisdom.
Real life,
Real money.
real faith.
I've been counting every step. Now I'm pressing through the noise. Hands up when the truth hit. I was built for this choice. This is Chasing Wisdom.
Real life,
Real money, real faith. Fade it out, then cut it clean. Chasing wisdom.